Hi, good morning, everyone. Thanks for joining the weekly research morning call. Today we have quite a few stock calendar updates, followed by the Euro technical pause and Singapore weekly. So without further ado, I'll hand over to Sean to present our FOMC meeting highlights. Sean, please.
Thanks, ma'am. I'll be going through the FOMC meeting highlights that happened just last Thursday. So last week, the Federal Reserve has stated that the economic activities are aligned with the dual mandate, but because the inflationary data points are still elevated, hence they have decided that currently it's still not appropriate to discuss any rate cuts at the moment, since they have not attained the confidence that they are seeking yet to decide any rate cuts at the moment. So they have decided to maintain the fifth consecutive time at a rate of 5.25 to 5.5%. So, I mean, before the meeting, I believe the key message that the market was looking for was the direction if there's any rate cuts to happen this year. Since for the past 2 months, inflationary data pointers came in slightly above market expectations, with February's headline CPI coming in 5 basis points higher at 3.15% year on year versus 3.1% that was forecasted, while core CPI also came in at 3.75% respectively. So this has given rise to the worries of cuts happening this year to be taken off the table. But I mean, in terms of guidance, if you were to shift your attention to the left of the screen, so this is the dot plot graph that was provided in this meeting. And in the first column, which is for the year of 2024, the committee members have penned down the mean interest rate projection for 2024 to be at 4.6%. So this is similar to the projection that was released back in December's meeting. And furthermore, I mean, Chairman Powell has also mentioned that their policy rate is likely at its peak for this tightening cycle. And if the economy continues to move towards the direction that they are looking for, then it will be appropriate to begin dialing back on their policy restraints at some point this year. Then moving on to the next slide. Yep, thank you. This is just an overview on the CPI and PCE graphs. And as you can see, in general, inflation is indeed trending down, despite the small upticks from the last 2 months' data. But these are just some small road bumps, like what the committee members have mentioned in this meeting. So these are just some upticks along the way before inflation can reach the federal targeted range of 2%. And with that, I believe that in this meeting, the market has gotten the affirmation that they've been looking for. And it is likely that we should be experiencing the 3 rate cuts that was being penned out in this SEP. But I mean, also do take note that if inflationary data were to trend even higher, then I mean, the committee members have stated that they are prepared to hold the rates for a little longer, or perhaps even raise rates if appropriate, if it's deemed necessary. I would like to pass on the time to John to share on Nvidia. Thank you.
Thanks, Sean, and good morning, everyone. So like you said, I'll just be running through a quick update on Nvidia's GTC event that they held last week. So GTC stands for GPU Technology Conference. Essentially, what I'll be highlighting here is the keynote speak by CEO Jensen Huang that was over 2 hours. But essentially, the main gist of it was, he was talking quite a bit about future state, including generative AI and what was really required in terms of computing, especially as a lot of traditional computing, or rather a lot of the computing is shifting towards accelerated compute from traditional computing. He did mention that in the future, they do expect that they would require about 30 billion quadrillion floating points operations, which is 30 billion petaflops. I mean, it's just a lot of computing power to train their LLMs as well as for generative AI. And essentially, what this was is he was basically saying that we need much more computing power, much more to do a lot of the processes that we're currently improving on. And so that's where the new product launches come in, and the newest one and the key highlight for the whole week was its new Blackwell AI GPU. So essentially, this is to to, I guess, surpass its older Hopper H100, H200 GPUs. So essentially, one Blackwell can perform about 20 petaflops of GPU. So you only need, I guess, 1.5 billion of them to run to reach your future state. Each of these Blackwells, when you look at the picture on the top right here, the Blackwell is the black square that he's holding on the left, compared to the Hopper, which is what he's holding on the right. So you can see there's a significant size difference, and that's where where the increase in computing, a big increase in computing comes from. A big reason is the size, and the bottom right is actually just a basic architecture of what a Blackwell chip, I guess, looks like. When you compare this to its older models, like the H100, H200, the new Blackwell chip can do about 2 times better training or more efficient training for AI models, and about 5 times better inferencing, while consuming about 25% of the current power consumption. So essentially, you get a lot more performance for a lot less power consumption, which makes this new chip way more efficient. Of course, it comes with a slightly higher price tag, expected to come in about 25 to 30% higher than a H100. So like all its other new product launches, it's always going to be a bit more expensive. So along with this GPU, they also had a supporting cast to it. So they announced its Q-Litho, which is a new generative AI algorithm for photolithography, which essentially is what a lot of semicon equipment and manufacturers kind of require. So it's speeding up the design of photomasks by 100%. So the key clients here would be TSMC and Synopsys. It also launched its new X800 InfiniBand and X800 Ethernet lines of network switches and interface cards. Essentially, as more data, more computing is required, that needs to be more data transmissions. So these products are essentially built and help to service the need for higher data transfer. As you see, both of these will deliver about 800 Gbps of data transfer. I mean, when you look at it right now, think about just your broadband, your fiber optic. I think the highest is maybe 5 to 10 Gbps. So this is 80 times, 100 times compared to that. In terms of the new partnerships that they were mentioning about, they're collaborating with a lot of your large tech companies like Oracle and AWS, as well as Google Cloud. Essentially, this was I guess the main reason for this conference was to highlight its new chips and its new products. But when you compare it to some of its competitors like AMD and even some of the hyperscalers that are building their own GPUs, like Amazon is actually building its own GPUs, actually has its own GPUs out. They are still far and above. Every time a competitor, matches their older model, a few months later, Nvidia will just start releasing a newer, upgraded, a better chip. And so so far they've always been one step ahead of the competition. Although this doesn't mean that their market share will remain, or they'll even gain market share as more people start to come into this AI GPU industry. You should start to see a little bit of erosion in its market share, especially as the industry is growing so quickly and there's so many more new entrants coming in. So that's all for my Phillip on the ground. We actually have a fundamental buy on Nvidia, which we announced during our previous earnings results, with a target price of $970. So that's all for me. I hand it over to Glenn to do his initiations on the USBanks. Thank you.
Hey, thanks, John. Yep. So for the US banks, we are initiating on 3 of the banks. I'll go more into detail. Mainly they are JP Morgan, Bank of America, and Wells Fargo. So for the investment highlights for just the sector in general and why we chose these 3 banks. Firstly, exceptional market share for these 3 banks. Look at the top right corner, you can see this pie chart here. JP Morgan, Bank of America, and Wells Fargo are the leading banks in the US. They hold about 40% of the total assets in the sector. And as of FY23, JP Morgan actually has the largest market share at 17%, followed by Bank of America at 14%, and then Wells Fargo at 9%. So interestingly, if you're looking at their loans and deposits, they also lead. They are holding 28%, of the market for loans and 32% for the deposits. So for, in 2023, there were several bank failures, and this actually increased their presence in the market with their total share of their total assets and deposits rising from 38% to 40% for assets and 31% to 32% for their deposits. So this dominance has actually allowed them to handle a significant number of transactions and deposits across all of their business segments. A second investment merit would be that peak rates are a catalyst for these banks. So the Fed's pivot from an aggressive rate hiking cycle to a more potentially rate cutting stance in 2024 is a significant catalyst. So for some background, when the Feds raised rates aggressively in early 2022, the banks were immediate beneficiaries as their assets tied to the benchmark lending rates were repriced to pay the bank higher rates almost immediately. And their deposit costs also lagged, which resulted in higher margins and no cost. So this is quite evident if you look at the bottom right chart here. You can see the blue line would be their cost of their asset repricing asset yield, and then the orange line would be their cost of funds. So you can see, in 2022, the blue bar overtook and actually rose way more aggressively compared to the orange bar. But however, this reversed in 2023 as the cost of funds repricing exceeded the asset repricing. And this is evidence. So you see the orange line overtaking the blue line. So you can see that this resulted in moderating NIMs across the sector. And with the rates reaching peak levels and potential rate cuts in the second half of 2024, we do expect that asset repricing will retake the lead from deposit repricing for most banks in 2024. And also the lower rates can support valuations. Now moving on to the next slide, we have my third investment merit, which will be the benign provisioning cycle. The bank's management of credit losses have normalized from the unusually low levels during the pandemic, with no signs of significant credit quality deterioration. So you can see the first top right corner of the chart here. You can see that both the blue and orange line, which represent the allowances and the net charge-offs, have sort of gone back to the pre-pandemic levels. And some losses are anticipated from the commercial real estate sector, but the banks have been monitoring these portfolios and also have set up specific loan loss reserves. Additionally, there was also no overlending in 2023. If we do compare the nominal GDP growth against loans growth, the blue line being the nominal GDP and the orange one being the loans growth, you can see that, in 2023, or at least the last few quarters of 2023, the nominal GDP growth did outpace the loans growth. Now, moving on to the next slide. So for the comparison of the three banks, and I think also why we chose these three banks, a bit more into detail. The JP Morgan is actually the largest US bank, and they have a very diverse business portfolio, and they also have the highest international presence amongst the three. If you look at the top right pie chart here, you can see that only 1/3 of their deposits come from North America, and that's United States. So the other third coming from Europe, Middle East, and Africa, and then lastly, Asia Pacific makes up about 20%. So they're quite global in that sense. And for their revenue split between net interest income and non-interest income is quite even, it's about 56 to 44%. For the second one, Bank of America, it is the second largest, and it leans more towards net interest income with 58% coming from their NII and the rest towards their non-interest income. They also have a more predominantly US-based asset distribution with 87% of their their deposits coming from the US. And lastly, Wells Fargo, they are the third largest by market share, and they stand out for its extensive branch network and a significant revenue contribution coming from their net interest income. So this is at 63%, it's the highest amongst the three banks. And despite having half the assets of JP Morgan, it has nearly as many branches, so it's indicating a strong middle market presence and potential for the deposit growth. Now moving on to the next slide. Just some key risk. So if the Fed fails to achieve a soft landing, in this scenario, the Federal Reserve is unable to orchestrate a soft landing for the economy, and as a result, the economy slides into a recession, which will be characterized by higher unemployment rates and a significant deterioration in asset quality. Persistent inflation and higher interest rates. So despite a slowdown in the economic growth, inflation will prove to be more stubborn than anticipated, and this would force the Fed to maintain the higher interest rates for an extended period. This would exert pressure on the bank's balance sheets, and this would be give some challenges for the banks in terms of funding challenges, liquidity strains, as well as unrealized losses. And the last one for the risk would be implications for fee income. Due to the prolonged high interest rate environment, coupled with a sluggish economy, this will constrain the recovery of their fee income sources. So the main areas such as their asset and wealth management, investment banking, and mortgage banking would face headwinds in this scenario. And this will also limit the bank's ability to offset potential declines in their net interest income. So now moving on to the banks itself. Yeah, next slide, please. Yeah, so for the banks, I'll go first into JP Morgan and the investment highlights for the bank. So for JP Morgan, the first one we have is their strong and consistent earnings, and JP Morgan has consistently outperformed the consensus expectations with its earnings per share or EPS. And they have actually exceeded their expectations for 6 consecutive quarters, which demonstrates the bank's resilience and adaptability in various market conditions. And this consistent performance can be attributed to a combination of factors such as their diversified revenue streams, efficient cost management, as well as strategic investments. For the second point is that their positive net interest income outlook. So for the JP Morgan, their 2024 outlook actually calls for a higher than expected net interest income of around $90 billion. And this the bank's ability to maintain a positive net interest income outlook, even assuming 625 basis points rate cuts, indicates its resilience in the face of potential economic downturns. For their net interest income outlook growth, they will most likely come from loans growth driven by their cuts, which will be offset by the moderating NIM from continued deposit repricing as well as migration. Lastly, moving on to the next slide, we have the continued share repurchase. So JP Morgan plans to continue its share repurchase program at a current net pace of around $2 billion per quarter, which is signaling the bank's confidence in its future earnings potential. So for their common stock repurchases, it rose 217% year-on-year to $9.9 billion in FY23, with 69.5 million shares repurchased. Assuming that their share repurchase program is maintained at the current pace, we could see the FY24 EPS rising by around 2.5% year-on-year. As such, we initiate coverage on JP Morgan with a buy and a target price of $231.19. We assume 2.07 times price over book value, as well as a ROE estimate of 20.2%. So moving on to the next counter. For Bank of America, for the 3 investment merits, the first one being that the manageable net interest income decline and slight expense growth. So the bank's 2024 outlook points to manageable declines in net interest income in the first quarter as well as the second quarter of this year, before modest growth in the second half of the year. And in addition, their expenses are also expected to increase only modestly. This suggests that they have a robust strategy to maintain its net interest income as well as control expenses, which could be significant drivers of its profitability in the future. So while their net interest income story was quite positive, the bank's expenses seem to be creeping higher, which is to be expected this year. Secondly, they have an effective loan portfolio management. So they saw an increase of 1% increase in loans, and this indicates that the bank has been effective in expanding its loan portfolio while managing the associated risk. And the growth in loans can lead to increased interest income, contributing to the bank's profitability. Moving on to the next slide. So lastly, for the investment highlights for Bank of America, so it's sound asset quality. So despite their having higher non-performing assets and net charge-offs, the bank's provision for credit losses was better than anticipated, and this suggests that the bank has actually been able to effectively manage its credit risk and ensuring that potential losses from bad loans are adequately recovered. This is also this is a positive sign, as it indicates that the bank is taking proactive measures to maintain the quality of its assets and safeguard its financial stability. As such, we initiate coverage on Bank of America with an accumulate and a target price of $40.82. Our valuation is based on 1.12 times price over book value and an ROE estimate of 12.3%. Now going to Wells Fargo, the last bank. The first investment highlight is that their softer net interest income outlook will be offset by controlled expenses. So for their guidance for 2024, it indicates a potential decline in net interest income, but this is to be expected to be offset by modest growth in the second half of the year. Additionally, the bank only expects a slight increase in their expenses, which would reflect that they are effectively managing their core income and cost drivers. For their net interest income outlook, it will be impacted by the path of the recent rate curve, as well as uncertainty existing around the timing and the extent of the Fed's actions. Secondly, there's also resilience in fee income. So the introduction of new card products has stimulated an increase in customer expenditure, and they have also been channeling investments and expanding its workforce in the corporate investment banking, particularly in trading, which has led to a rise in both revenue and market share. The elevated market levels compared to the previous year are also expected to enhance fees in wealth and investment management. So looking ahead to 2024, successful trading in revenue will depend on favorable market conditions, while the impairments in the venture capital portfolio are anticipated to diminish, making the remaining elements more foreseeable. For the last one, moving on to the next slide, will be the share buybacks. Yep, so Wealth Fargo's management has noted that the buybacks or the share buybacks will increase compared to the 12 billion in FY23. So for FY23, their common stock repurchases actually did rise already by 98% year on year to 12 billion with 272 million shares of common stock repurchase. So if you were to assume a very modest 10% increase in their stock repurchase program, we could see their FY24 earnings per share rising by around 9% year on year. As such, we initiate coverage on Wells Fargo with an accumulate and a target price of $60.83. And this is based on a 1.21 times price over book value, as well as an ROE estimate of 13% in our valuation. So that's all I have for the US banks. I'll now hand it over to Mel for SingPost. Thank you.
Thank you, Glenn. Update on SingPost. So they just reorganized the group and basically shift the focus from mailing towards a technology-driven international logistic enterprise. They reorganized the group into three parts: one for Singapore, one for Australia, and one for international. So each unit will have their freedom to expand in their own market and become the market leader based on what they are best at. Yeah, this provides clarity on the valuation on individual business against comparable markets and sector rating, such as Singapore will be focused on e-commerce logistics to achieve efficiency. And Australia business will leverage on its asset-light hybrid 4PL and 3PL capabilities to strengthen its position as one of the top 5 logistic companies in Australia. International business will focus on serving cross-border e-commerce and will expand the hubs in Singapore, Hong Kong, and Europe. And the group has also identified a list of non-core assets and businesses which is non-core to the strategy, and they look forward to monetize and recycle the capital. This includes some selected properties as well as some assets overseas. So this will help to deleverage the group by reducing debt, and more capital is available for investment, such as the ESG initiative, some infrastructure, automation for post office, and smart logistics. But we're still expecting some additional capex and headcount in the upcoming years. Yeah, the rest of the proceeds will be returned back to shareholders. So they also refine their dividend policy of paying out between 30% to 50% of the underlying profit from this year onwards. Yeah, that's all for me. I'll hand over to Zing for technical parts. Thank you.
Thanks, Mel. I'll move on to the technical. So first up, looking at S&P 500, it was up about over 2% last week. Currently, it's still trading within this short-term uptrend channel in blue. For this week wise, we're likely to see a pullback from the channel resistance. So for now, the resistance is currently at 5,250 to about 5,300 area, while the immediate support is likely to be between 5,155 to about 5,190 area. Next slide, please. Yeah, so for individual counters, first up, we have a technical buy for Tesla at $175.66. Take profit levels are set at $194 and $206. We will stop loss at $166. The stock last closed at $170.83 on Friday. So looking at the chart for Tesla, recently there was a breakout of a short-term downtrend resistance line. This was after the stock found support at the key descending wedge level Then afterwards, we also saw bullish divergence signals in MACD and RSI, which form a higher low, even when the price was hitting a lower low towards the support. So with that, we could see a recovery in the price of Tesla going forward. Next slide. Yeah, so next one is a technical sell for FV at $176.27, with take profit levels at $168 and $163, with a stop loss at $182. The stop loss goes at $178.45 on Friday. So looking at the chart for FV recently, there were some signs of weakness. So first up, there was a breakdown of an uptrend channel in blue. Then secondly, there was a false breakout above $180 with a double top as well. And looking at the MACD and RSI, there was also bearish divergence and decreasing momentum recorded. So with that, we could see a further pullback for the counter towards these two levels in time to come. Next slide. Yeah, so looking at the summary of the trades, for Tesla is currently down about 2.7%, and for FV is down about 1.2%. So that's all from me now. I'll pass on the time to Peggy to talk about Thomson Medical. Thank you.
Thank you, Zane. Okay, last week rather this morning we issued a report on the initiation of Thomson Medical Group. Okay, our target price is 6.6 cents. Okay, this Thomson Medical is a regional healthcare player. I refer you to the table on the right that lists out all the assets that they own. They have a hospital in Singapore, Thomson Medical Center, which is a well-known ONG hospital. In Malaysia, they own 70% of TMC Life Sciences Berhad. And in Vietnam, they just recently in December last year acquired a Vietnamese hospital. Is a FV. So the three assets combined has a license bed of about 757 beds. Just for comparison, Tan Tock Seng has about 1,400 beds. Okay, the key crown jewel in this Thomson Medical Group is 70% owned TMC listed on Bursa Stock Exchange. The TMC is recording record profit and record growth from having more beds. They also see higher patient loads, and they offer a bigger scope of treatment, and of course the bill size has increased. This TMC has room to increase its number of licensed bed from 350 currently to 535. This would potentially would enlarge their offering. And under planning in the groups is in Malaysia, TMC is planning a Thomson Iskandar Medical Hub in the Iskandar region for 500 beds. And in Vietnam, the FV is also planning an expansion to add 33% floor space to the hospital. And in Singapore, because they own a land under the Singapore, they own a land in Iskandar, 1 million square feet of land, freehold land bank, which they plan to develop into a medical and healthcare and wellness hub. Okay. The other positive for Thomson Medical is that the FV, which was acquired at end of 2023, will make up for the lower profits from Singapore. Sorry, can you turn? Yeah, thanks. As COVID-related contracts ended by the end of last year, and Thomson decided not to pursue further because the margins have gone to very low levels. And FV extends this reach to about 120 million population. So the upside to valuation comes from the development of the 1 million square feet Iskandar land, which we value at a development profit of 1.1 billion, based on the gross development value of 3.6 billion Sing dollars. This development profit is we think the development will take place between 2025 to 2030, and so we take the profits and discount it backwards to present, and this translates into about 4.16 per share, just purely on the development profits alone. The construction of railway link between Singapore and Johor, and and Iskandar being designated as a special economic zone. This is proposed by the Johor State Government. This could speed up the development plans for Thomson Medical Group. Okay, next slide, please, Neil. Thanks. Okay, these are some pictures to show what I've mentioned earlier. The FV, which was acquired at December 2023, we have a 6-month contribution in FY24 and a full year contribution in 25. And you can tell from this table here, both in terms of revenue and EBITDA, FV will make up for the shortfall of the Singapore. Singapore last 2 years had good years because government farmed out many contracts for managing the vaccination centers as well as for managing the transitional care facilities. And all this with COVID fading off, the contracts are also tapered off. So therefore, the decline in Singapore profits. The next slide, please. Like on the Malaysia side, just zoom in on Malaysia alone, you can tell from the chart on the left, Malaysia has been growing very strongly, both in terms of revenue and EBITDA. And margins is also aging up as the patient loads improve and they could achieve operating leverage. In Vietnam side, Vietnam's FV has been profitable since it was started in 2003, over the last 20 years. And FV has been growing its EBITDA margin as well, as you can tell from the red line, which is trending higher. Okay, next slide, please. Malaysian patient count has exceeded Singapore in terms of inpatient. If you look at the table on the chart on the left, Singapore is actually holding quite stable despite our declining birth rate, and despite the fact that foreign patient has been declining. But the bill size wise, Singapore still is rising, and Malaysia is catching up. Though this is because if it's in ringgit, it will be even stronger. Thank you. Next slide, please. And Singapore is losing foreign patients, as you can tell from the chart on the left. The inpatient and outpatient are both negative growth in FY23. But Malaysia is very strong. Malaysia has been growing inpatient by more than 20% the last 2 years. Next slide, please. In Singapore, birth rates, especially for resident birth rate, is down 5.5% each year in 22 and 23. And that explains the very relatively flatlining of the patient number in Singapore. So that's explain also the reason why the Thomson needs to go to Vietnam. You can tell from this table on the right, Vietnam will attract patients also from Cambodia and Laos. And so this gives them a market, addressable market of 120 million just from the Vietnam FV hospital alone. Next slide, please. In Vietnam, in terms of healthcare expenditure, is still trailing behind Malaysia and Thailand, and potentially could see more spillover of the patients going to Thailand, especially the foreign patients going also into Vietnam. During COVID, quite a lot of these local domestic patients have actually, because of the border closure, stayed in their own country to seek treatment, and then over time they grown used to the domestic hospitals and decided that it's really more cost effective to remain in their own country for treatment because of proximity. The cost wise, they don't need to incur accommodation, flights, and of course the cost is also cheaper, and the ability, the scope of treatments in the local hospitals is also improving. Therefore, the local patients are staying put, and there's also the explain why Singapore is losing foreign patients. So in terms of healthcare expenditure, these countries, Vietnam, Cambodia, has seen more than 9% growth over the last 5 years in terms of compounded annual growth rate. So this is Vietnam's venturing into Vietnam is a very, very strategic move for Thomson Medical. Next slide, please. Okay, I'll pass on to Paul for Q&M. Thank you very much.
Yeah. Thanks, Peggy. So for Q&M Dental, which is the largest dental clinic chain in Singapore, the results was released quite some time ago. Just that I wasn't around to present, but anyway, this is just a highlights of the results. The results beat our expectations about 121% of our full year forecast. The positives is the recovery in revenue and margins. After 2 quarters of weakness, especially after the exclusion of the pandemic test business that they used to enjoy, you can see that the revenue jumped 6% and adjusted PATMI, removing the one-offs, is up about 36%. So those were the positives. The negatives was the declining number of clinics. In Singapore, the story for Q&M was always that they were growing very aggressively, the clinics. But the downside of that was that they weren't able to fill the clinics with enough dentists and so forth. They had to close it. That's why they closed 2 clinics after a major expansion drive the last 3 years. In terms of the outlook, I think why we're positive is one of the things they're doing is they're rationalizing the network of clinics. So even though the number of clinics declined, the revenue still rose. And also they are utilizing their proprietary software that was developed, I think, more than 2 years ago, for higher revenue intensity. So higher revenue intensity means higher bill per patient, but it's not as bad as it sounds. So what's happening is that with this software, they can actually track patients that are undertreated. So rather than, just give an example, rather than you just the feeling you should, maybe the patient could have been better served not to put a cap or a crown and whatsoever. So sometimes they're underserved because some dentists just rather do the simple procedure or don't dare to sell the more complex ones for whatever reasons. So with this, what happens is that with all the dental records, with all the charting, with all the visuals of the teeth and so forth, they can actually come up with based on data or evidence based, they can actually come up with a recommendation. So what they found is that the dentists are probably underserving or probably under prescribing. So as a result of this, they managed to at least raise the amount of revenue per patient. We upgrade to accumulate to and buy. So in terms of the outlook, some of the drivers we think that can help them grow into 2024 will be the revenue per patient, which I mentioned earlier. More stable employee costs. So what hurt them in 2022 was also because of the huge expansion they were doing. And the shortage of nurses. They had to actually pay exceptionally high for nurses. But right now the pay levels are kind of normalized because they managed to normalize the amount of nurses that they have on board. The third driver is also the deconsolidation. So while this software is good, at the same time, this software is actually burning quite a bit of money for them. So they actually deconsolidated it because a lot of it is just R&D expenses. So that as they develop this software further, it won't be such a heavier burden on the listed company. And then they also the housing, they're beginning to see some turnaround. At least it's not loss making. If you look at the table on the left, the associates, you can see it's 120,000. Although it's small, but this is not a drag on the earnings. So this we think are the 4 drivers that can push the earnings into 2024. For 2024. Next slide. Okay, so next slide. So okay, we're not doing a health conference here. That's coincidental. We keep on talking about healthcare, but anyway, so our last week, Monday, Tuesday, I was in Jakarta for our first REIT visit. So we visited 4 hospitals. So to give you a bit of backdrop first, for first REIT, most of their assets are in Indonesia. So they are basically the landlord of 14 hospitals owned by this company called Siloam. So Siloam is one of the largest private hospital operators. They own 41, of which 14 is rented to First REIT. So the model, if you go under the right here, under the model. So the model is not dissimilar to how hospitals operate in Singapore. So the general practitioners are under payroll. So these are normal staff pay. But in terms of the specialists, the second bullet point here, the doctors collect 100% of the consultation fee for any outpatient and inpatient treatment. So this is very typical of a hospital revenue model. So what the hospital revenue earns is the the lab charges, the bed charges, the treatment fees, using all the facilities and so on, which is quite typical. So in terms of and the industry, about 60% is private and 40%. I think all, and Silom has about almost 10% market share. Out of pocket, I mean, if you want to know, probably Singapore has a lot more for insurance, but over there, 40% of the patients pay out of pocket. Insurance is still small. BPJS is just the universal healthcare, basically virtually free medical healthcare in Indonesia. So if in terms of the highlights for me, what based on my visit, so Indonesia is facing a acute shortage of specialists. So if you do any ratios like specialists to population, it's probably one of the lowest in the world. But so the key to doing well in Indonesia is to able to secure the specialists. So specialists are attracted by two very obvious things. I mean, they want the equipment and they want the patients. So what we've seen is that because Silom has invested very early, I think some of the hospitals are more than 20 years old. I think 4 hospitals or 5. With the patient flow, then they can invest in more sophisticated equipment, and of course that in turn attracts more specialists, which in turn attracts patients. So that's why the title report, what they're saying is that you are probably creating this perpetuating loop, this virtuous loop. You more patients, more equipment, that attract more specialists, and this will keep on continuing. Because you invested early and because you have the patients, you got the profits, you can reinvest. So that's one part of the meeting highlights. The second part is that, so what is the macro driver? I think this is nothing unique, but the 4 healthcare drivers for Indonesia is maybe more unique for Singapore because we don't have a growing population, but at least they have a growing population there. They have a rising rate of chronic disease, expanding middle income, and the spread of healthcare insurance, because healthcare insurance, which is only 30%. So the macro driver is also pretty positive for this. Yeah. So the company we visited actually is Silom International, which is a listed Indonesian company. Next slide. Sorry. Going back to the model again. Sorry. Just to refresh as to why this is important for First REIT. So First REIT collects rent from all these Indonesian hospitals. Every year it will increase by 4.5%. But this is in rupiah. So if you do an average, the Singapore dollar will appreciate roughly 2 to 3%. So this more or less kind of offsets the rupiah weakness every year. The kicker for them is a performance fee. So if they do better, then they will get 8% of the revenue, whichever is higher. And the key word here is preceding year. So although Silom didn't do so over 2022, First REIT still managed to capture, I think, 3 hospitals that have the performance rent. And actually Silom in 2023 actually doing even better. I think the revenue is up almost 18%. So you should expect the performance fee to continue into 2024. It's a preceding year. Why preceding? Because they need to get the Silom's audited accounts, which is few months away. Then by the time they implement, it's only, so they always be like 1 year lagging in terms of capturing the performance rent. Next slide. Okay, so the hospitals are 41. You can see all the dots here, the numbers. 41 hospitals is all over Indonesia. I mean, yeah. And the bottom here is the new hospitals. So first hospital 96, so they didn't really do much, but it's only in 2011 you notice there's a very aggressive ramp in hospitals, which I think because affordability, healthcare, insurance, and so forth. So they're one of the earlier aggressive investors into hospitals. Next slide. Okay, this is just some pictures. The whole report full of pictures because it's a Jakarta visit. But anyway, what we saw was very crowded. You look at the picture on the right. Some of the hospitals we went was, of course, not easy to take a picture when no one is looking at the camera. But this one is the one that has a lot of people. But if you go there, you will see it's very, very, very busy. They're also well equipped. There's a PET scan here, and some of them are like 12 stories, 16 stories. All are general hospitals. They do oncology, fertility. When I asked them about the impact of what happened in Singapore, like why the hospitals in Singapore saying that they're not getting as many patients, I mean, the comment we got was that when the pandemic happened, it was a bit of a golden period for them. Not because it was good, but it was mainly because a lot of the local patients could not go to Singapore, so they tried the healthcare facilities in in Indonesia, Jakarta, and it wasn't as bad as perceived. So that's why they call it. So a lot of them continued, and also of course much cheaper to do in Indonesia. Okay, next slide. I'll just move on to the Singapore weekly. Not much in the US, but I think for Singapore, we are actually experiencing quite a strong export recovery. I took year to date February and January because because the Chinese New Year, very hard to take 1 month, either January or February. It's better to combine both. So exports are up 8% compared to last year. Exports were actually down 21%. Of course, not fully recovered, but this is a rebound. Electronics not so strong, but at least pharma and chemicals are one helping. Another data point we got was RMC, which is Benefits Hong Leong Asia and Pan United. So this ready mix concrete. Just think of it like wet cement that if you drive around, sometimes you can see this truck rushing around. So that's all the wet cement, which is called ready mix cement, concrete, to be poured into all the building sites. If you're not clear what this means. It's still very robust. I mean, it's like up 33%. I think construction activity is resuming quite strongly. I won't mention this so much. We'll just talk about it next slide. So in terms of our tactical view, so I think like what Sean mentioned earlier, the key message from this whole meeting that what helped market rally is that the 3 rate cuts are maintained, at least the trajectory. And this is even before the Fed, because the Federal Reserve actually is forecasting stronger growth. So even though they think growth is stronger, but they still want to cut. So of course, it's a very positive message. The other message was, in January, February, inflation was higher than expected. But even then, the Powell just said that it's just a bumpy. So the market rallied on this thing called bumpy because they don't think it's a trend. They just think it's bumpy, which is good. So that's why the market rally. For us, we still think 2 rate cuts. We are expecting the market is expecting 3. I think for us, we're still thinking it's 2 rate cuts as per our strategy report in January. What we do see is that the US economy is flatlining. I mean, even though the US government is throwing 1.6 trillion or 1.6 trillion deficit into the economy. So this is a forecast by the CBO, the Congressional Budget Office. But even then, the economy is flatlining. The data we see is the PMIs, the industrial production, retail sales. They're all just moving sideways. So we think the economy isn't gaining much momentum. So we still think the Fed's going to do some cuts at the second half. The other talking point, again, not a Japan expert, but just to remind everyone, since it's a macro views, so Japan raised the rates. I mean, nothing to shout. It's like -0.1 to 0. So, but of course, the press and they removed this 1%, this yield curve control. So in the past, Japan always like to put a target to the 10-year bond, although 1% isn't such a great target. But even then, we still think the yen is going to come down because there's still a huge rate differential. We'll show you later. The tail risk for Japan is always, if the yen weakens, then inflation spikes up, then they have to spike interest rates, and then you weaken the economy, then the currency will weaken again, then you get this negative spiraling, but which can happen to some emerging countries and even in the UK in the 70s. But I think for now, because the Bank of Japan has almost 1.3 trillion of foreign reserve, so long as they can still intervene and support the yen, then you won't get this. But in a nutshell, I think the yen will still be weakening. Because currency always work on 2 differentials, interest rate and economic growth. And against the US, I think Japan definitely loses out. Some of the events, so the big event will be on the 29th of March. On Friday, you will have the core PCE. Although in the Federal Reserve meeting, he did kind of hinted that it's going to be a 0.3% month-on-month. So he did kind of give guidance of where core PCE is, which is pretty unusual. So in terms of the corporate insights that we have Mimontech. So Mimontech is basically operates out of Indonesia. They do all the water treatment plants in Indonesia and also construction of water treatment plants in Singapore. If anyone's interested, it's on Wednesday, 12 p.m. Next slide. So just 2 last slides for me. The one on the left is just to show that the exports is recovering in Singapore. Not so much electronics, but at least the other segments. RMC demand, which is ready-mix concrete, you can see is accelerating pretty fast. The table on the chart on the right, you can see I guess the ladder step movement probably reaching to record levels. So economic activity is still healthy in Singapore. Next slide. So this is my last slide. So we wanted to check did the interest rate expectations move much after the Fed meeting? It didn't really move much. So if you look at, I know it's a bit hard to see. If you look at the rate here, the green line was in February, then the purple line here is March, the most recent number. So probably the market just raised rates about 9 basis points, but they still expect 3 rate cuts coming up. Then the rate differential is still high in the US. So you can see here, this is the difference between the US and Japan. So US is almost 4 percentage points higher than Japan. So this one will actually make the yen weaker. Likewise, if you measure it on the real rates, it's almost like 2 percentage points higher. So this is just for reference. Okay, I think you can move on to Q&A. Thanks.
Maybe I'll take some first. Okay, the first one, it was in the chat. So will not future rate cuts be negative for these US banks as depositors withdraw to park in for riskier assets? And also, I think there's one more regarding whether it's a good time. Why is it now? Hold on, let me try to find it. Initiation of US banks at the potential time for potential rate cuts and economic slowdown, not mentioning the impending US elections. Wouldn't the timing be a bit off? Yeah, okay, so I can answer both of them actually at the same time. So, I mean, basically, the rate cuts, it might be negative for actually the smaller banks. But if you look at the bigger banks wise, this would reduce they're actually looking forward to lower rate cuts, because this would mean that their funding costs, which is what, as if you see my previous slide in the front, is what has actually caused their NIM to dip. So the loan yields, their asset yields are sort of like stagnating. So the only thing that's going up is their funding, is their cost of funds, which is why it's quite detrimental to the bigger banks at least. So in terms of you think that okay, the higher rates might also increase their allowances and their charge-offs, which is we saw that happening in sort of returning back to pre-pandemic levels. So when it goes down, it can both benefit their loans growth as well as maybe sort of level off their allowances and their NPLs. Okay, let me go to the next one. Oh, one more. How does investment in US banks versus Singapore banks as dividends are subject to withholding tax? Are US banks more for growth, capital gain, or dividend? Yes, definitely it's more for the growth and capital gains. You cannot compare compare Singapore banks to US banks. Singapore banks would be more for their dividends, because you look at the dividends, it's all around 5 to 7%, whereas the US banks is hovering around the 2 to 3% range. Yep, so for definitely, you're right, it's more for their capital gain and the growth. I think one more here. It seems that upside scenario for these banks may seem to be driven by shares buybacks. Yeah, so the US banks are actually quite aggressive with their share buybacks, and this is also beneficial because it sort of lowers the denominator for their earnings, so it will increase their earnings per share. And I think, as I mentioned earlier, also for JP Morgan, if they do follow suit with their current trajectory on their earnings, so their share buybacks, it will increase around 2.5%, and I think for Wells Fargo is even higher, around 8%. I think one more about Citibank. What's your view on Citibank, as you have not included it in your US banks initiation? Yeah, you will not include it because it's not, it is large, definitely. I would say it's the fourth largest by market share. And mainly because for Citibank, I guess my view is that they have to get their cost cutting. So what they're doing now is that they're really lowering their expenses and their cost cutting. So which is adding a lot of this one-time expenses for them, which is quite bad for their bottom line. But if you look at their core business, it's doing quite well. And I think the management just needs to ensure that they are able to get they're changing the whole company, right? So if they get that right, then it's possible that they will do quite well. I don't think there's any more for me. Maybe I'll hand it over to the rest of my colleagues. Thank you.
Let me do some stuff. Okay. There's a question. The top headings. Thomson Medical, how much risk going forward in April for not able to resolve the shareholders' requirement? Yes, they have up to 10th of April to increase the free float. Currently, it's below 10%, so they have SGX approved a waiver for 3 times now. So how they can do it is, one is of course to issue new shares. And then that would then probably raise some money for the balance sheet. The other way is of course for Mr. Peter Lim, who owns 90% of the company, to sell down his stake. I can't I'll never say never, but the management sounds confident that they can resolve this, but I don't have a definite answer on how they're going to do it. So the date is 10th of April. Otherwise they might have to just seek another waiver from SGX, which doesn't look likely that they need to do that. Yeah, thanks. Okay, the next one is also on Thomson. Thomson Singapore is losing foreign patients. Is this specific to Thomson? Do we have the foreign patients trend numbers for Singapore? No, I think it's across board for all the private hospitals. The foreign patient count, even the specialist clinics, the foreign patient counts are coming down, except for the many very critical cases. I tried, but I can't find a breakdown for there's no data, no statistics to show how many foreign patients that we have coming through to Singapore. So I'm afraid I don't have the number. They're just and some of these numbers are just from conversation with the doctors, so probably not so reliable. Thanks. Next question. Hi, I read an article in BT this morning about increasing jet fuel demand going forward. Which listed company here would benefit most from the above? Please advise. Thank you. Because our biggest the company that has the biggest exposure to jet fuel will be China Aviation Oil. The rest of the players are most likely the refineries, which are they're not listed in the Singapore Exchange. Yeah, so far we think with China Aviation Oil will benefit the most from this increased demand. Thank you. Hi, what's the news behind Best World's big price jump today? Okay, if you notice last weekend, the 2 announcements came out from Best World. Of course, the more significant one is that some of the major shareholders actually proposing a special capital reduction, such that they will appoint an IFA, independent financial advisor, to advise how much of the assets in the company should likely each shareholder should own, and then the major shareholders will refrain from their rights, while they will dispute what is due to minority shareholders. So it's more like equivalent to an exit offer. So therefore the price rose in tandem with this. Thanks. What are your views on Hong Leong Asia and Pan United given the RMC demand trend? Pan United is definite buy for to ride on this RMC, because the RMC is their main core activities, and they've been very successful in introducing low carbon solutions, which is adopted by the PSA, the CapitaLand Group. So it's not just in Singapore. These solutions are also being used or going to be used in other countries which Pan has an exposure, like Vietnam, for instance. So definitely benefit Pan. For Hong Kong Asia, the business for RMC is Hong Kong Asia's business is more China Yuchai, cement business in Malaysia, and RMC and a 20% stake in BRC, the steel rebars business. So you just look at Hong Kong Asia, the the current environment that's being very positive for them is the high cement prices in Malaysia. Cement prices now is so much is already higher in Singapore. So all the cement sellers, the cement producers are just selling in Malaysia. They don't come into the Singapore market to compete. So for Hong Kong Asia, it will still be benefit them in terms of higher RNC demand, but they have a much more busier time with a very good uptrend in the cement demand in Malaysia due to the robust construction activities that now being carried out in Malaysia. Thank you. Is PRC a buy in view of RMC demand? No, PRC is mostly in steel rebars at 80, slightly more than 80% in terms of steel rebars in Singapore. So if you think about building materials demand rising, of course the steel rebars are also growing along with it. But RSC, the dynamics is different. Steel rebars you can ship into, you usually get them shipped into the Singapore market. So it also depends on the property China property construction demand in China. Yeah, so the different factors affecting the PRC, so not exactly correlate directly with RNC demand. Thanks. I think I'll pass back to the team. Thank you.
Yeah, let me take some. Thanks, Peggy. Any news on CLI's capital land investments dividends? Yeah, so actually no news. It's just that they will be paying 12 cents for the FY23 dividends. So this 12 cents will go XD, or the X date for this 12 cents is 4th April 28, and the pay date will be May 5th. May 10th. So April 28 and X date and May 10th is the pay date. Yeah. Yeah, there are some questions on Manulife. So okay, so for Manulife, basically, you already know their whole C-suite, that includes the CEO, CFO, CIO, deputy CEO, they have left, and then there's their replacements ready. So yeah, that's the latest, and I think some of the management also, like the directors and the chairman also, they added some stakes, or rather they bought some shares in the open market. So that those two news are the latest for Manulife and Manulife ESREIT. But the issue right now is that Manulife, they've just signed their recapitalization plan, so they will have to they'll proceed with their divestments and their recapitalization strategy, where they'll plan to bring their gearing down, because the gearing now is above 60%, so it's still in breach. Yeah, but the good thing is that they have this plan. I've done the presentation before, so basically the breach has been lifted, so waived, or rather not lifted. The breach has been waived, and they extend the payments of, or rather the loans maturity will be extended by 1 year. So that will be helpful, because right now in the US, a lot of banks are not, rather there's very little bank financing, or rather no financing to these US commercial properties. So that's the issue. And also, yeah, like I mentioned, the gearing. So they'll have to settle these two issues. Yeah. The outlook for S-REIT seems Fed is slightly possibly lower rate 3 times this year. Yeah, so as you all know, also the REITs, the share price is very volatile recently because of this Fed expectations of rate cuts and whatnot. Like suddenly 5 rate cuts, and suddenly the market price in another 3 rate cuts. So if you look back at end of last year, the Fed came out and they mentioned that they already expected, or rather the Fed funds expectations were 3 rate cuts this year. So it's relatively no change from then. So yeah, for outlook for S-REITs, we are still quite we are still overweight S-REITs, as we still think it's a good U play, and the REITs will benefit from the Fed cuts. Yeah, so our outlook and price to NAV wise and forward dividend yield wise is also attractive. Like the price to NAV wise, the REIT index is trading at negative around -2 times standard deviation. So that is around pre-COVID lows, or sorry, not pre-COVID, around COVID the lows. Yeah, so that's also why we think valuation wise is attractive. And if you are a long-term buyer and seeking yield, yeah, REITs could be an option. Yeah, of course, together with the banks where like DBS paying so high dividend yield. Yeah. Yeah, your view on the future of Prime US REIT. You still have a buy rating with the resignation of their CEO. Something not right. Yeah, so actually for Prime, we moved it to under review for the time being. So yeah, for Prime US REIT, the biggest issue is there are loans that they need to refinance. So the expiry is July, so they have to refinance about they have a 600 million credit facility under their main facility that they need to refinance. So this is the issue for now, the biggest overhang. The CEO that will be taking over, Hamid, is a shareholder of the manager. So he was the one who actually set up the REIT, yeah, at IPO. Yeah, so it's one of the people involved from since the start of Prime US REIT. Yeah, so we are still waiting for more details. We are also not sure what exactly happened during the change. Yeah, so we can't really comment on the management, but fundamentally, the biggest issue right now is the $600 million US dollar in loans that they need to refinance ASAP. Yeah, will it be good for people who have stake in it and those who do not have stake? What would be good for people who already have stake, and yeah, so I can't really comment on that. Yeah, but I've cautioned that you check Prime US REIT with a lot of caution now. Yeah, because there's a lot of uncertainty also in the market. Like regarding US commercial REITs and whether they can refinance their loans.
Darren, you want to remind everyone when is the next refinancing period for Prime?
Sorry, what do you mean? When is the next? The current loan expires.
When's the next loan due?
Yeah. Due July. So they have about 3 months left. So yeah, so the biggest one is the 600 million and is due July 2024 this year. Yeah, so regarding the refinancing and the change of management, it would have been better in my personal view that if this refinancing was already done and then the CEO handover, that would have been better in my opinion. But because we are not quite sure what will happen, like during the discussions with the banks, especially, like well, while you're discussing like, oh, we're going to refinance this loan, but then suddenly the CEO just changed, so not sure what the banks would think about that. So yeah, that's a bit of yeah, we struggle to think how the situation there. So we're just waiting for more details. Your view on retail hospitality REITs. I believe the first one is CapitaLand Escort. The second one in the comment is Suntec. So I'll leave Suntec to Mel. Yeah, but for CapitaLand Escort, we are still bullish because we believe that lodging will still remain very strong this year. Like a lot of events and especially the return of Chinese travelers worldwide and the increase in flight capacity as well. So all these will help with hospitality REITs, and RevPAR also we believe will continue to trend upwards, but at a slower pace because from the higher base. So perhaps we're expecting a single digit RevPAR growth across the board this year. Yeah. Yeah. There's also a follow-up question on Manilife's US REITs chairman and directors adding stakes. Positive for investors, or one has to be cautious? Yeah. So there are two ways to look at it. So one of it is perhaps the management directors think that the share price for Manulife is trading too cheap, and perhaps they would, of course, they think it's a steal to invest in their own shares, and they believe there's a lot of upside going forward. Perhaps after they do make some changes to the plans and execute the Manulife recapitalization strategy. There's also another way to look at it, but I think this is more unlikely. The fact that they just want to kind of have a support level for the share price, I think this is more unlikely. So yeah, like basically they don't want the share price to crash so much, but they're doing it at their own expense. So I don't think this is this is the reasons. I think it's part of the former reason where they think that there's a lot of upside. So yeah, I think it's a good sign for that they are adding their own stakes. Yeah, I think that's all for me. I'll pass on to colleagues. Thanks.
Yeah, anyway, for the US REITs. Oh, sorry, what's my camera? Oh crap, sorry. Anyway, for the US REITs, I think most of them are down like 90% over 2 years. So the no need to argue whether cheap or no and all that stuff. That's like that train has already left the station. So everybody knows it's cheap. So the thing you have to consider is whether can they survive. So that's the most important thing. And the second thing is the timing. So if you look at it objectively, timing. Okay, so you look at timing wise, the July is going to be critical because if Prime cannot refinance or they need some equity top up, then all the US REITs is going to get so long. So that could be the one trigger to buy. And of course, the second trigger for timing wise is the results are all coming out. I don't think there'll be anything great because the problem is also the banks are not open to refinance. There's going to be a lot of tightening of refinance because the valuations for most of these commercial properties came out only in December. So refinancing headlines could also be still bleak in at least the first half of this year. So news flow could still be negative, but probably could be the last batch of news flow because everybody knows this is bad, right? So the second thing is who has the highest chance to survive? I mean, as an investor, that's going to be your bet. I mean, these things dropped 90%, so cheap, no need to talk already. It's obviously very cheap. So the thing now is that if you look at the three REITs, to be very objective about it, I think, at least from my own view, is Keppel Pacific Core is probably the one. If you look at all the metrics, if you want to be objective, you look at occupancy ratios, look at liquidity gearing, everything. And it's not that they couldn't pay the dividends, they just held it back. So they actually couldn't pay, but they just held it back to conserve the balance sheet, to survive in the next 2 years. So I mean, objectively, that is probably the one that has the best metrics. So you're just betting on who survive. So if you compare if you base three together, that seems to be the ratio wise. I think next time I can ask Darren to do a check, like who has the better chance to survive. That would be the more appropriate metric than all this price to NTA, dividend yield, which is all totally waste of time. Anyway, yeah. Okay, let me just move on to some of the questions. Hi Paul, Q&M Dental divestment of AI venture EM2 reduces funding requirement, but does it imply the initiative is successful? It's not. I think because it's going to be a drag on earnings, and they need funding. So one way, the benefit of that is you get funding. The second benefit is you can at least crystallize some value. So in case you want to sell some stakes in this. The blue sky scenario is that this software is used internally by all the clinics. That means, and you can actually brand it. That means it's like, I don't know, all the Q&M dental clinics are powered by this, or because it's evidence based. It's not some dentist opinion. And another blue sky is that if they can sell this software to other clinics outside Singapore, whatever, and maybe charge $1 per use or whatever. So that's the thing. It's mainly because it's losing money. Then and if you can kind of take out some of the losses out, then you will help the group. A bit of an accounting accounting thing that they're trying to do. I don't think it's about whether this thing is not performing well or not. Yeah, because one of the features of this software is to read all the records, read all the mapping. That means the map of your tooth, everything, the graphics and everything, and come up with a solution. So it's not so easy as there's a lot of development work involved. And it costs a lot of money, so that's why they take it out of the P&L, at least to remove some of the losses. To make obviously to make the listed company look better too. Paul, why first REIT price drop from 125 to 24 cents? Okay, let me give a bit of history here, but if I don't feel it right, fill it up rightly, then maybe Darren can chip in. So first REIT last time paid very high yield because most of the exchange okay, so in the past, first REIT only collected rent from one party. It's all the hospitals, I mean mostly, but only one party, which is the Lippo Karawaci, the Indonesian developer. But then after a while, Lippo Karawaci's financial standing could not keep paying because they were basically like a change. I mean, we were kidding, basically like a change addy. They were money changer because they were paying the rents in Sing dollar, which is of course good for all the investors here. But who take all the exchange risk? Who's the money changer giving you all the Sing dollar was Lippo Karawaci, the property developer. Until they said it is affecting their finances, then they cannot do it anymore. So one of the restructuring they did was to collect in rupiah. So the hospitals now pay in rupiah. And the second thing is that they collect direct from the hospitals, whereas in the past they collect from Silom, the hospital's parent. So that's why the thing came off so much. Yeah, and I'm not sure there was also some capital raising that caused the thing to drop. I can't remember that part, but that was one of the reasons why the share price dropped. Yeah. Okay, let me try to. The sponsor of First REIT is OUE Hospitality. The company seems to not have a good corporate governance track record. Any concerns? I can't comment on OUE but at least from the First REIT point of view, there hasn't been any like major issues. It was just the whole structure of, like I said, how they structured the rents in Sing dollar rather than rupiah. So I think that now it's cleaner. Okay, the only risk now, sorry, I forgot to mention, is that they still collect rents from Lippo, or not 100%, but at least I think now 40%. And slowly, bit by bit, the rents will be slowly collected direct from Silom rather than Lippo. That's the other. That was one risk that they have. But I think Lippo's balance sheet, I think, is getting a bit better now. We will share more because they're having a briefing tomorrow. Okay, can you comment on the US national debt in relation to the imminent interest rate cut? Okay, the debt actually is more of a moot point. So although the interest as a percentage of the debt continue to rise, I think to 15-16% of all the revenue is to interest, but so long as the confidence in the US dollar is still there, I think this thing will just keep on running. So the debt is now around 110% of GDP. It can go to 120, 130, 140. It's very hard to time this until we see investors lose confidence. Then you become like what happened in Europe, where or even in UK. If you remember in UK last year or the year before, where the interest rate spikes because the people lost confidence in the UK sterling or UK bond, then you're gonna get this big problem. But I think for US, their debt can go 120, 130%. Like doesn't really affect anyone because there's no other substitute for the US dollar. So I'm not so worried about that. Although on paper it's a concern, but at least the next 3 to 4 years, I don't think there's any issue. Yeah, you only worry when all the bond investors start to say that no, they don't want to take US dollar debt and they want higher interest rates. Well, and it's not happening. Paul, you shared the electronic export activity not so positive. Then your view on Aztec Global. Okay, Aztec Global is a contract manufacturer. It's a very different animal. So Aztec Global, the exorbitant privilege for Aztec Global, like the US dollar, is that they are the private label manufacturer for Amazon. So their major customer is Amazon, which is Blink. And if you are a private label, I mean, the best thing to be is to be a private label manufacturer for Amazon, because Amazon knows the best price. So Amazon, I give you an example, Amazon sell batteries. So how is anyone going to compete with Amazon on batteries? They know what is the best selling price of the competitor. For them, it's just to get the cheapest cost in it. They know all the market information because everybody buys from Amazon. So you can imagine you have a competitor that knows all your customers, know all your selling prices, knows where are the best markets. So in the end, so that's why they're doing well, because Amazon is their main customer and they are like the private label. The Blink cameras like the private label of Amazon. The only risk for Aztec Global is that they are the single source. So Blink only takes them as the manufacturer. So unless that also the other thing why we also didn't really want to cover, because we never know when they were second source, which may or may not ever happen, but we do not know. So that's the biggest risk for Aztec. That if Blink, because they take all only from one manufacturer, which is Aztec. So if they decide to second source, then that's the big risk, which as an analyst, I do not know how to address it. So that's why we didn't really cover them. Yeah. But if your customer is Amazon, because the best customer to have, they can outrun any competitor out there. I mean, of course, unless unless it's naive to think that they don't like share the information and so forth, I guess. Yeah. Okay. Okay. This one for John. I'll take this one for SingPost for Mel. What is the estimate DPU on SingPost with the payout increase compared now? So SingPost usually pays about 60% payout ratio, but we think the earnings can rebound because their domestic postal operations is turning profitable. So dividends should increase. But everything we say here is a moot point because they're still going to go through this major restructuring at SingPost, which is the government has already said they need it could come in three ways. Just to repeat, sorry if you heard this before. So there's a big restructuring happening. SingPost doesn't want to operate all these letters, which is delivering letters, because it's losing money. So there are a few ways the restructuring can happen. So the government can take back all the assets and then just let SingPost operate and pay them a fee, or they can everything's the same and then just compensate SingPost on like something like Netlink, give them every few years, give them check how much is their cost of capital, then let them charge an appropriate rate of return. And then if it's not through higher postage, the government will pay, or like the earlier model I mentioned, something like what the SMRT or the train stations are, the government control all the assets and they just give you a fee to operate, like all the bus. Nobody knows the model. I mean, I'm not sure myself, but whatever model the restructuring is decided is only going to benefit SingPost. I mean, yeah, otherwise why do it, right? Because the government is basically saying, I'm going to help you stand the losses and I'm going to help you turn profitable, which is what the whole internal restructuring means. So it's going to be positive for SingPost, but there's nobody knows how is it. But yeah, so it's going to be obviously going to be positive for the share price. So government is steady, I'm going to make you profitable. Yeah. Okay, any point, your view on Del Monte? I haven't really been following. So sorry, I should be following it closer, but I haven't really. But I will try and ask them for whether they want to do a webinar with us, so at least just to address most questions that we have on the company. Okay, I think I hand it back to the. Okay, Hyper, what's your recommendation on Thai Bev? Is the share price? Yeah, no change in our view. It's not. For my own thoughts, it's not so much Thai Bev. It's the whole Thai market is also very weak, because everyone is still waiting for the government to spend. Our view on Thai Bev is mainly highlighted before. Sorry to repeat, but it's mainly a fiscal thing, because we still think the government's going to do aggressive fiscal spending to support the Thai consumers. Then when that is over, then hopefully, then we think the Vietnam can recover, because Vietnam has been weak for the last 2 years because of the weak macro conditions. Thai beverage is all about macro conditions. Nothing to do with about their beer or spirits business, where they own maybe like 40% market share to 90% market share for the spirits. So it's more a macro thing which we think can improve. I mean, that's our own view. Yeah. Okay, I hand it over to the rest first. Yeah.
Thanks a lot. I have a couple of questions. The first one here is on Nvidia. Why don't you increase the target price of Nvidia even with the announcement of Blackwell? Yeah, so actually, I guess the honest answer is because it's already kind of been priced in our valuations. Because we knew about Blackwell even before the official product launch. And secondly, because revenue will only really start to translate probably towards the end of last year and more towards next year. Yeah, so that's why we didn't really change our target price because we also still expect production, I guess, to be, or rather revenue to be supply constrained rather than demand constrained. So it doesn't really make that much of a difference in that sense with the new product launch. Yeah, I hope that helps. There's another question here on what is the outlook for the US market this week, especially the Magnificent Seven. Yeah, so I would expect some sort of a little bit of weakness, a little bit of consolidation, especially after the week that they had. I mean, last week was quite a good week for most of the, I guess, most of the Magnificent Seven stocks. The US market in general also kind of rallied last week. But we're reaching a point where I guess you're starting, like Zane said, you're starting to see a bit of resistance and a little bit of weakness coming to grow through. So my guess is it'll probably still remain a little bit choppy. At least for the next, not just this week, but at least for the next few weeks until earnings are to begin again, middle of April with the US banks. Then maybe we'll start to see a little bit more volatility coming. Yeah, I hope that helps. Yeah, I'll pass it on to the rest of my colleagues. So, thank you.
Yeah, I think I've got 2 more or 3 more questions. Yep. So someone asked, is JPM has risen quite a lot now. What is the risk of its trend starting to turn? Yeah, I think the reason why this might be happening is also because there's sort of a bit of a flight to sort of safety, because if you want some exposure to the US banks, you don't want to go with the smaller ones, because I think that will go link into my second question here. So a lot of them are going to the biggest or the largest ones, which are more stable, definitely not seem to be more stable. Yeah, so that's the reason why it has risen quite a lot. And I think what's the risk of its trend starting to turn? I don't think it will turn if they do meet their sort of targets, and I think they have also been sort of outperforming what the expectations are. So if they continue to do that, I don't think there's really a very high risk of it trend starting to turn. For the second question, wish to hear your comments on exposure and risk of the lending to commercial properties by the 3 US banks and the US banking sector as a whole. Yeah. So this has been quite a hot topic currently and for quite a number of months already. So what happened is that the higher interest rates, as well as the back to normal sort of like working environment from pre-COVID, I think the pandemic sort of has lowered the number of working from office days, right? So this has hit their commercial real estate properties quite a lot, and the higher interest rates as well. So for the overall as a sector, the banks they have increased their provisions, their allowances, as well as their net charge-offs in general, and also most of it it's due to this commercial real estate sector. So for the 3 US banks, I would say that they are quite secure and quite safe. Overall, they only have around, I think, 8% of overall loans to the real estate sector. If you compare real estate sector to the total loans portfolio. And I think the highest among them would be JP Morgan at around 12%, and then we go to Bank of America around 7%, and then Wells Fargo has 4% of their total portfolio made up of the commercial office sector. And I think the larger banks are quite safe because they do set aside provisions, and it's a very small sum. It's less than 1/10 of their total portfolio. So they have the ability to set aside the sufficient provisions, and they've also done their checks. So I think the main I would say the risk would be the smaller banks. So smaller banks take on quite a lot of this, and around nearly from data it's shown that nearly 1,900 smaller US banks with assets less than 100 billion actually have CRE loans outstanding which is greater than 300% of their equity. So that is quite scary for the smaller banks, and we could possibly see some of these smaller banks not being able to cope with this, especially if interest rates are maintained, so they might not be able to cope with this, and they might either fail or collapse. And we have seen that, even with JP Morgan, they did acquire that the First Republic. So it will only be a good it might only be a good thing for the large banks, because when these small banks collapse and they are forced to take over these small banks and acquire them. So they will just grow even larger. So these three banks, the three larger banks, are going to hold their position there for quite some time. I think okay, there's one more about the outlook on I think USBank Corp and Western Alliance. Yeah, so we are just concentrating on these three banks first. I will go and do some research maybe next week, then I'll come up with some of these on the other US banks. There's so many banks in the US, so it's really hard to cover all of them, Yeah, but I'll get an answer to you regarding USBank Corp as well as Western Alliance. Thanks. Okay, I think that's all for me. Let me hand it over to the rest of my colleagues. Thanks.
I think I'll take the rest of the. Where's the retail? Yeah, for the retail outlook, like Darren mentioned, we are positive on retail. Like for some tech rate, the fundamental is still strong. Yeah, we expect Singapore market to be the key revenue driver due to the limited supply. Like retail rental reversion, probably for some tech rate will still be low to mid-teens. Yeah, and we also expect higher contribution from some tech convention. Yeah, as MBS Convention Center is still under renovation. But the main drag is from the overseas market. So the recent sell-off of Suntec rate, we believe like potentially was because ESR group, they announced like they want to divest the non-core asset. So the instant investors, worry about Suntec will be the target. And there's another question for Paragon and Lendlease. Like how will Chinese travelers benefit those rates? Yeah, so Lendlease will definitely be the beneficiary upon like arrival of Chinese tourism, since seriously, as Summer said, accounts for a very large portion of the total income. Yeah, with higher tenant sales and lower occupancy costs, Lendlease is able to charge have a higher rental reversion, upon renewal. And for Paragon rate, since it's mostly the high-end products and luxury brands in China is usually like 10 to 20% more expensive than the one in Singapore. Yeah, so tenant sales will improve, as Chinese travelers gets back. Yeah, even though Singapore dollar appreciate a lot. Yeah, so will erode some purchasing power, but still like the high-end products is way more cheaper in Singapore. Yeah, so also will reflect in their rental reversion. Yeah, that's all for me. I'll hand over to the rest of my colleagues. Thank you.
Zane, you want to take over? 12:30 is technical.
Yeah, I'll move on with the technicals. Yeah, let me just share my screen. Okay, so the first question will be on Seatrium. I think for now, Seatrium currently looks like a bear flag consolidation after a breakdown last Monday. So I would think that the likelihood is for further downside if we see a break below 0.077. Then next one for Palantir. For Palantir, there's still some weakness for now. Last week after a breakdown, it did a retest of the broken uptrend channel, still showing some weakness. So I think we could see a retest of the current support around 2340. Then if we see a lower low, then likely we got a retest around 2230 for Palantir. With Nvidia, I think it's been ongoing that it has been ongoing a consolidation for quite a while. But on Friday there was a closing above the 920 resistance. So with that, I think in the near term there could be some further momentum upwards to retest the high around 974 over here, and then possibly a new highs if it decides to test the ascending broadening wedge trendline resistance, which has acted as a key resistance in the past. Okay, then for Manulife REIT. Okay, Manulife REIT, after a pure range trading as some broken out recently. I think for now we tested previous support level breakdown 0.075 around there. So I think we could see some potential consolidation ahead. Okay, for Aztec, I think currently some range trading going on. So the previous resistance was 1.02 holding as a support for now. But I'll expect some resistance on 1.06, 1.07. So possibly some range trading consolidation for now. And then for capital senders, I think recently there was a double bottom at 265, then price did a rebound. Currently at a resistance level around to 276, where we have this trend line over here as well as a recent swing high. So you could see a little bit of a consolidation. But if there's a break there, I think we could see retest around 282 over here. Okay, then next is Franklin. Franklin, some range consolidation for now. So after the breakdown over here at 169, is indeed acts as a resistance, but the previous 160 breakout level is acting as support. So yeah, it's just some range consolidation for the time being. Okay, then next up is on Semco Industries. Okay, after a period of a sell down, and was a range over here breakout last week over here. So I think for now could see some range trading. So with support around the 520 level. First resistance level will be around 535, then followed by around 543. So some range consolidation. The next up is on China Aviation Oil. Okay, for China Aviation Oil, I think some range trading ahead. So recently we tested the previous resistance around 89 cents. However, I think some resistance likely to be around 91.5 cents to 92 cents level. So possibly some range consolidation ahead. Okay, then Riverstone. Riverstone some strong momentum lately after the break of this 74 cents level. Went to retest the previous swing high resistance at around the 80 to 81 cents level. Then currently there's some looks like some consolidation likely to take place for now. Okay, next up is on Goku Land. Okay, for Goku Land, I think generally quite range bound over here. So coming back to the resistance around the 151 level, where there's this downtrend resistance line as well as a key horizontal resistance. So I expect to probably face some resistance and turn down in the near term. Okay, then next up is BYD. Okay, BYD, I think still facing resistance at the key $216 level. So possibly some range bound consolidation ahead. Where first level of support is around 206, 207. Then next level will be around close to 200. Okay, then as for BYD Electronics, generally quite range one as well. So the previous support breakdown level around at 32 has become a resistance. For now, support is around the 28, 29 level. So I will expect some continued range bound consolidation. The next one is Star Hill Global REIT. Okay, for Star Hill, I think still quite range bound as well. There's this downtrend resistance line acting on it with a resistance around the 48 to 49 cents level. So I expect some continued range bound with support around the 46 to 47 cents level. Next one is CDL Hospitality Trust. Okay, CDL Hospitality Trust. Okay, recently I think is some sideways around at the resistance level of 98 to 99 cents level. So if can hold, but recently some positive signs with the higher lows as well as price tried to break above it. If you can hold this level, I think we could see some rebound towards $1.01 to $1.03 level. Okay, next up is Singapore Airlines. With Singapore Airlines, I think some range consolidation for now. So if for now the support is at 635 is holding. So I think for now we need to see how high it can bounce. If you can break the 647, then likely we could see price rise towards close to 650, 660 around there. Okay, then for City Developments, for now it's still trading these downtrend lower highs along this downtrend resistance line, also retested around the 590 level over here, facing resistance. I think with this, we could see price turn down for now to retest around the 570 to 575 zone over here. Then for IBEV, I think for now revisiting the range support, which is around the 48 cents level, 48 cents to 49 cents level over here. So price could just sideways a little while for here, then could see some rebound to continue a very long range consolidation. Okay, then for Baidu. Okay, for Baidu, I think recently we did a double bottom at 95. Then price went from a higher low over here. So I think we could see a retest of the 105, 106 level with a recent swing high as well as this downtrend resistance line over here. And some resistance around 107 over here as well. So after that, we could see some sideways consolidation. Okay, next up is Ping An Insurance. Okay, for Ping An, I think the chart wise didn't look so good from Thursday onwards. So until then, it was still holding this uptrend line over here. But after that, there was a breakdown and breaking this swing low around 33.70. So that I think for now we could see some downside to price to retest support level around 31.60 level before some rebound take place. Okay, then Yum China. As for Yum China, some weakness in price as well. So there was a range trading that price broke down for the 41 level, then went back to retest 37.80, a previous resistance. There was a bit of bounce, but subsequently the selling came in again. So I think that if we can't hold this, then I think we could see some further downside towards around 36, about there. Okay, next up is Amazon. Okay, Amazon I think is still range trading for now. Still a lot of resistance around 179, 180. But overall, it's still in this uptrend over here. So I think if it can break out, a bit, then I think we could see some further upside towards 185 to 188. Okay, then for Google, I think some range consolidation over here. Yeah, so I think likely we could see the range consolidation continue, given that some resistance likely between 152 to 154 for the time being. What's the outlook for US energy ETF sector going? So I'll take a look at the XLE ETF, which is the ETF for the energy sector. I think overall it still looks quite positive. So recently there was a new high being created around, currently it's around $92. So yeah, with that I think still quite positive with this gradual uptrend over here. Okay, for Tesla, I think currently it's still the key is to hold this 166. I would think that for now some resistance likely between 173 about there. 173 to 178. Yeah. So for now, probably some sideways consolidation for time being. Okay, then next one, AMD. Okay, for AMD, I think some weakness in terms of price action. There's a break below this key blue color uptrend support line. And price is currently holding at this previous resistance around 178. But if this can't hold, then likely we're going to see price continue its short-term pullback over here to test 172, or even feel the price go over here to test 160 or 165 about there. So some short-term weakness for AMD. Then as for ARM, I think ARM is some sideways consolidation for now. Currently at the key level, which is around 136, where it has this downtrend resistance line as well as a retest of a swing high, and then a previous support breakdown here. So I think for the price to go upwards, if there must be a break above here, then it could trend higher towards like 146, 147 about there. Okay, then there's a question of Wilma. Wilma, I think for now, generally still quite range bound over here. The price tried to break above this 343, 344, but it was tend to test like 349 over here, but subsequently there was a very fast pullback again. So I believe it probably it's probably going to continue range consolidating in this range for the time being. Yeah, the support around 330s over here. Okay, then next one is on Food Empire. Okay, Food Empire, I think some bearish signals recently. So after a consolidation over here, there was a break below 137, and then finding resistance along this trend line over here as well. So yeah, it did a retest, and then subsequently we saw selling pressure again. So currently it's holding at support at 133. If this gives way, then I think we could see further bearish momentum to test close to 127, 128. Okay. Okay, why Yang rebounded so strongly? You can accumulate now. Looking at the chart, I think it's doing a retest. Yeah, retest of the 190 level, perhaps the recent swing high. Yeah, so I think if you're looking to accumulate, you could wait for slight pullback if it does a bit of a consolidation. Current support will probably be around 183 to 185 level, where it kind of sideways a little while over here. Next is a TA for Alibaba. Okay, for Alibaba, I think still some weakness for now. Still seeing lower highs as well as price coming to test the support probably. So I think some further pullback towards like 60, around 68 to 69 again to test the support. Okay, next one is the 贵州茅台. Generally, I think it's still quite range bound over here. Still seeing resistance around 1740 about there. Probably come back to test the support over here 1660 about there. Then probably just continue to trade sideways. Okay, will UOP drop further? UOB, I think for now, is probably doing a retest of this resistance level breakout around 2860s, 2860 about there. So I would think it probably hold around 2850 to 2860 for now. And to just do some sideways about there. Okay, next one is on Meituan. I think for Meituan, I think it's just probably consolidate, is some sideways consolidation for now. Still some resistance around 97. But this looks like a possible bullish trend, given that previously was in this up wave over here. So I think if you can clear, then I think it's more positive. It's looking positive to a retest of 105, 106 level previous support. Okay, next one is on UOL. Okay, for UOL, I think currently just some range consolidation. I expect resistance will still come in quite strong around 590 over here upon the retest of this previous key support level. Okay, next one is Hong Kong Land. Okay, Hong Kong Land also just some range consolidation for now. I expect resistance to act around 320, those region about there. Okay, next one is DFI. Okay, DFI also just still range consolidation for now. So resistance coming around here 215 onwards. Yeah. And then Jardine Matheson also still looking a bit weaker for now. With these low high, lower lows. I think probably it could come down to revisit around between 36.80 to $37 this support area again. And then maybe just continue sideways. Okay. This one is Apple. Okay, Apple I think is still some weakness for now. So currently still some resistance at a lower high of 177 about there. Then price is holding at the support level of 168, 169. So I think for now could see some sideways for the time being. If it doesn't hold the recent lows, then probably we're gonna see price dip further towards like 165 about there. Then next on TSM, okay. Some rebound from this blue color trend line, uptrend line support around 186, but I think still some resistance around the 140s level on here. So probably some sideways trading for the time being. Okay, next one is on Lululemon. Okay, Lululemon, there was a sell down after the earnings release, but I think it tested a support level where there was this uptrend support line, and then a previous key horizontal resistance close to 387. So I will expect, and then so I will expect some short-term wise. I think short-term wise, the downside is probably kept around there. Upside wise, I think some resistance will come in around 420 to 430 about there. Then it could just sideways a little while. Okay, then for Starbucks, I think Starbucks is still generally looking some sideways consolidation recently, 90 to about 93, but still looking a bit weak over here when see still making lower highs and lower lows. So if the recent lows can't hold, then I think probably the price could go further downwards towards like 88 in the future. Okay, then next one is on Intel. Okay, Intel some range consolidation for now. But the key is to see whether the support over here at 41, 42 is able to hold. If it can't, then we might see price pull back further outside of this range consolidation towards like $39 or $40 for it. Okay, then Microsoft. Okay, Microsoft I think is still trading well in this uptrend channel over here. So the price action is quite good. After breakout of 415, there was a back test and then price rebounded to form new all-time high. So I would think it's likely for Microsoft to continue trading quite strongly in this gradual uptrend. Is Apple on the downtrend these days? Yeah, Apple is currently in the downtrend. Okay, I'll take one more. It's on Yen Lot. Okay, for Yen Lot, I think there's still some weakness. You see lower highs over here, and then higher low being formed recently, but it's testing a prior support level breakdown around the 49 cents level. We also have the swing high resistance at 50 cents over here for now. So we'll expect probably some sideways trading for now with resistance around 49 cents to 50 cents continue act on the counter. Yeah, so I think that's all from me. I'll hand back the time to my colleagues for other questions. Thanks.
Yeah, okay, Glenn. Okay, thanks, Zane. So I'll just try to wrap up everything, try to end it by one. Hi, Paul. Can you brief demanding retail REITs to public, mostly in Singapore after postcard? Sorry, I'm not very sure. Sorry, Amira, I'm not very sure what the question is, but if you're asking how the performance post-COVID, I think it's healthy because of supply, but I think the bigger question is how did all these retail REITs survive during the pandemic? And probably that's the most amazing thing, because if you compare it to some of the Indonesian malls like Lipo, because of the pandemic, like they're almost collapsing. So for post-COVID situation, I think because supply is very contained in Singapore, retail sales probably trading 2 to 3%. And they are also benefiting because some of the rents renewal will be like 3 years ago when there's a pandemic. So I think the demand is relatively stable. Okay. Any update on Paul? Any update on Uni Asia? Missed the webinar. Any write up on the company? Yeah, we dropped coverage. We don't have. I didn't attend the webinar, but the two things is plaguing them right now is because the bulk carrier. I have written on them for I think almost a year, but the bulk carrier rates have come down because of what's happening in China, and then they are selling the vessels. So it's more like a consolidation phase for Uni Asia. So they're disposing some of the vessels and then preparing for the next upcycle. Yeah. So when the fleet shrink, that what it only means is that revenue is going to come down even if the freight rates go up. So growth is going to be very sluggish because they sold some of the vessels to conserve cash and then to build up the capital for the next vessel ordering that they will plan, which I'm not sure when. So that's on the bulk carrier. The second part is on the Hong Kong. Hong Kong is problematic because Hong Kong, their total exposure is about 30 million. The Hong Kong now, we're not sure is that once these buildings are built, how the banks are going to react. So whether they need to inject more equity into these assets or not. Because as you know, the occupancy rate in Hong Kong now for office is, I don't, in the core areas is almost as high as 10%. I didn't listen to the recent Hong Kong land briefing, but the occupancy rates are still rising. I mean, the vacancy rates in Hong Kong is still rising. So the near term is still going to be very challenging because Uni Asia builds these properties on strata basis to sell to mainly Chinese buyers. So Chinese buyers, of course, after what's happening, their balance sheet is probably not looking so good after what's happening in China. And also in Hong Kong, there's a huge vacancy. So it's going to be a bit challenging for Uni Asia for the next, my own view, at least the next 12 to 18 months at least. Then target price on Genting, we don't have it on Genting. Answer this last one, then I think we can end it. Why is UMS and AEM not growing like the semiconductor counters in the US? Oh, okay. So actually, if you just take if you take UMS and the SOX ETF, your performance is probably more or less there. So what it means that you don't actually have to buy UMS again. Let's buy the semiconductor ETF. You probably get the same performance. But anyway, okay? So the rally you see now in semiconductor is mainly because of AI, because of GPUs. But the GPU's volume is very small. So if you look at GPU, let's say you take 80 billion sales of GPUs as roughly, and you divide by 30,000 per unit, just very rough numbers, you're looking at only 2 to 3 units of GPUs. Compared to the phone market is 1 billion units a year. So even though GPU grow, you're not going to move the unit. So if units don't grow, it's not going to benefit equipment makers like UMS, AEM, because they're mainly equipment, and equipment demand only rise if the utilization rate go up, if more demand for units. So UMS and AEM is really going to depend a lot more on units, more so on UMS rather than AEM, because AEM might have probably a better traction to HBMs or whatever. So, but anyway, that's in general. So the real kicker for a lot of the semicons is whether the AI chip can go into the client. That means if the smartphones need an AI chip, or then it's a different ballgame. Then all the semicons can rally. All the semicons can rally because now the volume you're talking about 1 billion unit. Although the price may be small, but it's going to raise utilization rate for equipment, and then the whole supply chain will benefit. So right now, it's only Nvidia and their own supply chain that's benefiting, because when you have an AI GPU, you also need the whole server, the memory chips, and so forth. So that's why you don't see a broad-based benefit across all the sectors. Okay, I think we hit 1 p.m. So thanks everyone for your time and for your questions. I have to rush for another meeting. But anyway, thank you everyone. Wish everyone have a good week ahead. And thanks again for all your questions. I hope it was useful for you. Yeah. And sorry if I have missed 2 or 3 more questions. Apologies for that. Thank you everyone and have a good week ahead. Okay, bye-bye.